Picture this. You're scrolling through your investment app during lunch break, and something catches your eye. Yesterday, your portfolio gained $380. You worked a full 8-hour shift that same day and took home $310 after taxes. Your money just out-earned you. Not by some wild crypto moonshot or lucky stock pick. Just regular market growth while you were sitting in meetings and answering emails. This moment has a name, the crossover point. And most people will work their entire lives without ever experiencing it. I'm Ryan, and today we're calculating the exact moment when your investments start working harder than you do. Here's what the crossover point actually means. You have two financial lines in your life. The first is your monthly expenses, everything it costs you to live. For most Americans, that's around $4,000 to $5,000 a month. The second line is your investment income, what your money generates passively through dividends, interest, and growth. For most people starting out, that second line is basically flat. Maybe you've got a few thousand earning you $20 a month. Not exactly life-changing. But here's what changes everything. As you invest consistently, that investment income line curves upward. Not in a straight line, but exponentially. Compound interest accelerates over time. The crossover point is the exact moment when that investment income line rises above your expense line. When your portfolio generates enough to cover your lifestyle, whether you work or not. Let me show you the actual math, because this is where it gets real. Say your expenses are $4,000 a month. That's $48,000 a year. Using the standard 4% safe withdrawal rate, you'd need $1.2 million invested to generate that income indefinitely. That's your crossover number. Now, I know what you're thinking. $1.2 million? That's impossible. But let's actually run the timeline. You're 30 years old, making $60,000 a year, investing $500 monthly at 8% returns, which is below the stock market's historical average. After 10 years, you'd have $91,000. That generates about $300 a month. Barely a dent in your expenses. After 20 years, you'd have $275,000, generating $900 monthly. Getting closer, but still not there. After 30 years at age 60, you'd have $670,000, generating over $2,000 a month. You'd hit the full crossover point around age 65, traditional retirement age. So what's the big deal? Here's where this gets interesting. The crossover point isn't fixed. You can attack it from both sides. If you cut your expenses to $3,000 a month, you only need $900,000. That's $300,000 less. That saves you roughly 7 years. And if you're spending less, you can invest more. Bump that to $1,000 a month, and you hit $860,000 in 25 years. Combined with lower expenses, you cross over at 55 instead of 65. You just bought yourself a decade of freedom. But here's what the spreadsheets don't capture. The mental shift that happens as you get closer. When you first start investing, it feels pointless. Your portfolio goes up $30 one day, down $50 the next. The crossover point feels like a fantasy. But something changes around $50,000 to $100,000. Your portfolio suddenly feels real. A 2% gain isn't pocket change anymore. It's $1,000 or more. You start to feel compound interest working. And your relationship to work changes before you even reach the crossover point. When your investments generate $500 a month, that's your car payment covered. At $1,000, that's groceries too. At $2,000, most of your non-housing expenses are handled. Each milestone gives you more bargaining power, more ability to say no, more freedom, even while you're still working. There's even a concept called coast fire. The point where you've invested enough that compound interest alone will carry you to your crossover number by retirement age, even if you never invest another dollar. For example, if you're 30 with $150,000 invested, that'll grow to $1.2 million by age 60 without adding anything. You could switch to a lower-paying job you actually enjoy. Your retirement is locked in. Now, I know the objections. What about market crashes? Yes, the market will drop 30 to 40% at some point. It always does. But that 8% average return we're using already includes every crash, recession, and panic of the last century. And here's the key. You're not withdrawing during the accumulation phase. When the market crashes, you're buying. You're getting shares on sale, which actually accelerates your path to the crossover point. What about inflation? The 4% withdrawal rate is specifically designed to account for inflation. And stocks historically hedge against inflation because companies raise prices, which flows through to earnings and stock values. Your crossover number will rise with inflation, but so will your portfolio. They track each other. Is there risk? Of course. But the alternative, never investing and remaining completely dependent on your paycheck until you physically can't work, isn't less risky. It's more risky. Here's what I want you to do right now. First, calculate your actual monthly expenses. Go through your bank statements. Be brutally honest. Second, multiply that by 12, then by 25. That's your crossover number. Third, subtract your current investment balance. That's your gap. Fourth, figure out how many years until you close that gap at your current investment rate. Fifth, ask yourself how you could accelerate this. Higher income? Lower expenses? Both? Here's the reframe that changed everything for me. Every dollar you spend has two costs. The money itself and the crossover time you sacrifice. That $15,000 car upgrade doesn't just cost $15,000. At 8% returns, that's $30,000 in 9 years, $60,000 in 18 years. It costs you months or years of freedom. The crossover point makes this trade-off visible. And once you see it, you can't unsee it. The lines will cross. They always do for people who stick with it. And when they do, you'll realize your money is finally working harder than you are. If this changed how you think about your finances, hit that subscribe button. I'll see you in the next one.